I just forgot to record. Okay, never mind. Anyways, rule number 3 is to buy with a margin of safety. So there's a book Warren Buffett like highly recommends called The Intelligent Investor. I don't know if you guys have heard of it or not before. So one of the reasons why it's so special is that it introduced the important concept of margin of safety. In investing, a margin of safety is formed when you buy an investment at less than its value while using conservative assumptions. Basically, what that means is a margin of safety is when you buy a company at a pretty low price with not a lot of money. And the idea of margin of safety is that you want to buy a business at a price that is low enough that your assessment can be completely wrong. Like that business could be terrible. It could lose all of its money and be bankrupt. And you wouldn't lose that much money. Rule number 4, do your own homework and own what you know. So there's no substitute for your own work. Don't just buy stock. And I think this book has said that a lot of times. Don't buy a stock just because a magazine or newspaper recommended it, or like your friend or cousin or like relative or something recommended it. And successful investors know what they actually own. Like don't be owning a share of a company that does something you completely don't understand. And most of the extraordinary gains made in the stock market come after a stock lost a lot of money or after it has already risen a lot. But um, you're not really gonna have the confidence to stick with a company like after it lost a lot of money or after it gained a lot of money and you think it's overvalued. You're not going to have the confidence to stick with a company unless you actually know what the company is doing. Like some people, they buy a company because other people are buying it. And then when the company or the stock market goes down a lot, they sell at the lowest point. Rule number 5 is to don't follow the herd. Like to stay calm and rational. So the typical bias decision is usually heavily influenced by those around them. Like buying when other people are buying, or like your friends are buying, selling when other people are selling. And like this psychology is actually this like pressure is actually pretty big. Because if you look at because imagine if like all the people around you were buying a company, you would probably want to buy it, right? Unfortunately, this is something that can backfire a lot of times. The best investors are the ones who can fight this urge and remain calm through a storm, or like through this major trend. As Warren Buffett said it best, be fearful when others are greedy and be greedy when others are fearful. So this quote is actually really famous. So yeah. So far, does anyone have any questions about this? Okay. Hmm? Okay. Rule number 6. Don't put all your eggs in one basket, but don't have too many baskets either. So as we all know, you have to diversify your portfolio, right? It's a really important strategy for your portfolio so that if one stock or one sector of like the market blows up or it goes really down, you won't like lose all of the money or almost all of the money in your portfolio. Because sometimes you just make a mistake, right? That's why you have to diversify your portfolio. But some research suggests that 90% of diversification can be obtained in most markets with a portfolio of just over 20 stocks. And the more you diversify beyond that, the less you know about each investment. Like we know Peter Lynch, he has like 150 stocks, or he had 150 stocks in his fund. But that doesn't mean you have to have like a lot of stocks either. The more you for normal people, the more you diversify, the less you know about each company. Um, so while diversifying is crucial, try to limit like the amount of stocks you have. Like don't buy 30 or 40 or 50 stocks. Maybe just around 20. And rule number 7, don't view your luck as a skill. So there are like millions of people who can earn 20% in 1 month, right? If the market just goes up, or if they pick a pretty lucky company who just had a really good period. There are tens of thousands of people who can earn 20% in 1 year, or that like if there's a really big bull market, or like you picked a really good stock that during that year went up. There are thousands of people who can earn 20% annually for 3 years, like if there's a really big bull market. But there are just a few people who can earn 20% annually for more than 20 years. So maybe you're just lucky in the stock market for a short time, but it's still extremely difficult to earn a lot for a long time. And question number 8, this one is kind of like this one you might think is kind of obvious. Never stop learning. Because the thing about investing is that the markets are always different and changing, and never really stop learning about businesses from like other and really legendary investors, and don't stop learning from your own mistakes. So here are some quotes on the right. Okay. So does anyone have any questions about this so far? Okay, no? Okay. So now let's move on to the questions for the chapters. The author wrote that you can find terrific opportunities in the neighborhood or at the workplace, months or even years before the news has reached the analysts and the fund managers they advise. So can you like list some great companies in your opinion that just by looking around yourself, for example, just by looking around yourself, you can find some products some really great companies are making that you're using. You just have to look. For example, this is kind of obvious, but this computer I'm using right now. Wait, is it Apple? I think it might be App. Yeah, it's Apple. And Apple is a really good company, right? Or for example, your favorite place to go to, I don't know, Disney. And even though it might not be your favorite place to go to, but Disney's a okay, pretty good company, right? This is mostly an open question. So does anyone have any ideas? Like you can just look around at your favorite restaurants, products, places to go. Yeah, Chloe?
Like Target, Walmart, and then yeah.
Sorry, Chloe, I couldn't really hear you. I don't know why.
Target and Walmart
Walmart?
and Target.
Oh yeah. Yeah, those are really good examples, right? Walmart and Target are both pretty good companies. Like annually, they earn about 10 to 15%. Like, I don't know, but like they're actually pretty good companies. Um, so anyone else? Think about what's your favorite food?
Oh, what about those my Crayola markers?
Yeah, Crayola, I think might have a company. I haven't actually like searched it up, but that's a really good idea, Kai. Wait, actually, I kind of want to search that up right now. This Crayola. Oh, Crayola. Wait, stock. I don't. I don't know if Crayola has stock or not. I know it has a company. Sorry. Yeah, Crayola actually has like a company with a stock. I think. Oh, really? Then why did generative AI say? Okay. Well, Crayola isn't really listed on the stock exchange, I think. For some reason, Google gave me the wrong thing. But does anyone else have any other ideas? Someone in the chat. Oh yeah, Amazon. Wait, who said that? Oh yeah, Amazon, Facebook, and Google. Yeah, those are really good companies too. Like maybe you have a phone, or maybe your parents have a phone, and they go on Facebook one thing, or like you search up on Google, like I just did, or like Amazon when you're buying something. Yeah, yeah, that's great. So does anyone else have any like ideas? Okay. Oliver, do you have any ideas? Honestly, you can just look around you at some product you really like or you just think is pretty good. Like last time I mentioned this drink called Celsius, right? Turned out it had this company who was publicly traded, I think by the stock, and it turned out to be like a really, really, really good stock. So Oliver, Amy, Livia, Daniel, Evan. Okay. Well, actually, there are some pretty good companies, right? Even if a company isn't that good, you can still list it, um, and find out later if it's a good company or not. So for example, have you ever tried soda or anything? There's a Coca-Cola company. That's a pretty good company. I think Warren Buffett bought a lot of shares of Coca-Cola or something. He also bought a lot of shares of McDonald's, I think. Yeah. Well, you some other companies are like McDonald's. Chipotle also has a company, right? Yeah, that's a restaurant. Um, wait, I saw something in the chat. Yeah, Nike. Oh yeah, Evan, like the Crocs. Yeah, I think Crocs has a publicly traded company, right? Wait, does it? Yeah, it does actually. Oh yeah, I've heard of that company before. Yeah, those are all like amazing suggestions. For example, Crocs or things you wear. For example, I think there's a company. I think like the the Gap, like a clothing store has some stocks. Like is like publicly traded. Um, Domino's Pizza is publicly traded. Papa John's Pizza. There's like companies who build houses or anything. And if you think your house is really great, you can search up what company built that house, or like if your neighborhood has a company or not, and if that company is publicly traded or not. Yeah. Okay. Right. Hold on. I'm gonna do something. Let's save that. Yeah. Okay. Okay, so now let's move on to chapter 3 questions. So according to Peter Lynch, oh well, typo. But anyways, according to Peter Lynch, when a person bets on like something like horses, I actually have no idea how you bet on horses. But whenever a person bets on something, like for example on horses, is he or she gambling or investing? And why? Let's just answer that first part of the question. Because Livia answered, like raised her hand first. I'll call on her. Yeah, Livia.
So if you're like betting on racing horses, you'd be gambling because you don't know if it's gonna win or lose. And that's just different from buying a stock. But with the horses, like anything could affect it. Like the one you're betting on could fall on the floor, trip on a rock, or I don't know, hurt its leg, or suddenly get really slow. And you would be gambling because there are like millions of things that could affect it and make it go wrong, and you could lose just like a ton of money.
Yeah, interesting, Livia. Yeah, those are great suggestions. Does anyone else have like slightly different answer or anything? Because this is an open question, right? Most of the questions today are open questions. Okay. So when a person bets on horses, wait, hold on, I'm gonna change a setting. So when when you bet on horses, most of the time for normal people it's gambling, as Livia said. Because it's unpredictable, you don't know what could happen. Of course, for some, for very few people, like a minority, um it could be investing, like if you're a professional horse bettor or something and you have a lot of experience and you can like look at horses, predict which one would win or anything. But mostly for most people, for like the majority of people, it's gambling. So here's like a follow-up question. When a person buys stocks, is he or she gambling or investing, and why? Chloe?
Um, the person is not gambling to me because um stocks have fundamentals where you can know if it's a good company or not, and also stocks. There are multiple strategies when you buy, so it's not really gambling because you're using um facts, factual information to help you buy.
Yeah, great, Chloe. Does anyone else have another answer? Like, this is a right or wrong answer. Oh no, this is not a right or wrong answer. Actually, different people have different opinions. Okay. Okay. Well, for most people, like it depends. No, for like in my own opinion, it depends. If a person just buys a stock because a friend or their favorite magazine or a family member said so, then and like without actual research, like in and it's just like in an instant, that's gambling, definitely. Or if like they think the stock market is probably gonna go up because last time it went down. Yeah, that's gambling. Of course, if a person actually does research on a stock and actually there's like research on the stock, they pick it carefully and everything, that's investing, right? And they look at the stock, they know the product is good, they've done some research, the fundamentals are great. Yeah. Okay. So now let's go on to the questions for chapter 4. Oh yeah. So as a side note, you guys read chapter 2 to 5, right? Oh no, 2 to 6. Yeah, today I'm just gonna do the questions for chapter 2 to 5. Okay. Okay. So according to Peter Lynch, before you buy a share of anything, there are 3 personal issues that have to be addressed or should be addressed. So what are the 3 personal issues? You can just name 1 or 2 or like whatever you think. Yeah, Chloe?
So 2 of them are if you have a house, and the second one is, can I afford to lose money? Can I afford to buy stocks?
Yeah. Great. Does anyone know what the third one is? Okay. Well, so these 3 personal. Yeah, Evan.
It's if you have the personal qualities that will bring you success in stocks.
Yeah, great, Evan. So the 3 personal issues, if you have a house, if you can afford to lose the money sometime in the near future, and number 3, if you have the personal qualities. That's great. So question number 2, this is like a follow-up question. Why did Peter Lynch suggest people to buy a house before buying stocks? Actually, he named a lot of reasons. You guys want to do a competition? Like who can like answer a question the first?
But are we allowed to like look in the book? Because for the first question, I looked in the book. Like, are we allowed to look in the book for the questions?
Okay. Okay, Chloe.
So it says finally, you're a good investor in houses because you know how to poke around from the attic to the basement and ask the right questions.
Yeah, I'm good, Chloe. Does anybody else have like something else? Yeah, that's a reason. Peter Lynch suggested like 6 or 7, I think. Yeah, I really should do a competition this time. Okay, so Chloe has 3 points. Second person to answer has 2 points. Chloe. Oh, I spelled your name wrong. I spelled it like slowly. Okay. Chloe.
Yeah, there's another one. It says, you'll do better in houses than in stocks.
Yeah, great. Okay, fine. Because I know most of you probably skimmed, and I kind of skimmed too. So I'm just gonna repeat some suggestions. He suggested like 6, 7. So number 1, because in 90% of the time, a house will be a moneymaker because most people like they can tell a house, they can like most people are better and like investing in houses than stocks. Also number 2, because of leverage where you can like make this down payment, you don't have to pay the full amount. Because of leverage, you get a high return from buying a house. And number 3, you get a tax deduction on your house or like on like like not a house, on local real estate. Number 4, you have like a place to live in, you have like a roof and stuff, and like walls and stuff. You have a place to live in. Number 5, you won't just sell your house because you get scared by reading a headline in newspapers or like in a TV or on social media or something. Because honestly, imagine you had a house, okay? And you had a pretty good house, and then you read in the newspapers, oh no, house prices are going down. Would you really just like sell your house and panic and sell your house? And this is like an open question. You guys can just blurt out your answer. Would you actually just sell your house? Because
No.
yeah, I know, right? Number 1, you have to
No.
if you actually sell your house, you have to pack all your stuff into this truck and like put it somewhere. You have to do an open house thing, ask people to tour your house, and like find someone who is willing to buy your house, which could take ages. Then you have to fill out loads of paperwork. You have to like make compromise or something. You have to bargain, and then you have to fill out more paperwork. And then once you get a house sold, you also have to find a place like another house, So number 6, houses like stocks are likely to be profitable when they are held for a really long period of time. And most like around 90% of all houses, like most people will like own them for at least 7 years on average, but 87% of all the stocks on like the New York Stock Exchange, like all of the stocks in America, or not just America, like in the stock exchange, change hands every year. Like around 90% of all the stocks change hands every year, maybe like multiple times every year. And number 7, people spend months choosing the houses, but they spend minutes choosing the stocks. If you choose house, you have to look at this and look at that. You have to see if the neighborhood is good. You have to see if the house is built in a good place, like not over a sinkhole or something. You have to check the quality of the house. You have to make sure there's not any termites or ants or like mold stuff. You have to check if it's in good condition. You have to check like if it's in a good neighborhood. I think, did I say that already? You have to check if it's like if there's like a lot of shops near it, if you like shops or anything. You have to check if there's a good school next to it. If you're in a public school or anything, or if it's near to a school you go to. Yeah. Okay. Moving on to question number 3. How do you understand the statement, stocks are relatively predictable over 10 to 20 years? As to whether they're going to be higher or lower in 2 or 3 years, you might as well flip a coin to decide, as Peter Lynch in the book said. So this is an open question. So how do you understand this whole statement? You don't have to look to the book for this. Just say what you think the author is saying. Olivia?
I understand it as like usually stocks will go up over 10 or 20 years if they're like modern, and if they're outdated, they'll go down. But like if it's gonna go up in 2 or 3 years, which is a smaller period of time, it's harder to guess because anything could flip it around, like bad news or a bad investment. But like generally they'll go up or down over 10 or 20 years.
Yeah, amazing, Olivia. Yeah. So basically, how I understand the statement is that you can overall predict like the general growth or like decline of a stock over 10 to 20 years, right? Because then some small changes or small ups and downs don't matter that much. But you can't really predict if you are going to be higher or lower in 2 or 3 years. Like it's harder to predict because there might be a scandal or something, or the company might be having some really good periods of time, like some really good quarters or anything. So question number 4. Oh, by the way, do you guys have any questions about this so far? Okay. So question number 4. How much Chloe, do you have a question?
No, I can answer.
Okay. Oh yeah, I forgot to do the competition. Okay, well never mind. I'll just skip the video one. Okay. So Chloe,
Okay, so it says in the book, only invest what you could afford to lose without that loss having any effect on your daily life in the foreseeable future.
yeah, good. So basically, yeah, that's what the like the book said, and you're right. Only invest what you can afford to lose without that like loss having any effect on your daily life, like in the foreseeable future. Of course, like if you're a legendary investor like Warren Buffett, you could probably invest like most of your money in the stock market, like 90% of your money. But for normal person, just follow that rule, okay? So question number 5. What personal qualities are needed for a successful investor in stocks? Does anyone else have an answer except for like Chloe? Okay, Lydia. Sorry, Chloe.
You need to like not have to be like afraid and sell your stock if one bad thing goes on about it. And you have to not like copy what the people like that are really famous or something buy, because like you can just look around and see what's good around you. And you need to be able to do that, I guess.
Yeah. Yeah, great, Lydia. Um, does anyone else have like a slightly different answer? That was really good, Lydia. Yeah. Okay. So yeah, that's what Livia said. There's some personal qualities that are needed, like discipline. Like if the stock market is going up, don't like if the stock market is going down a lot, try not to sell like all of your stocks or anything. Like Evan, do you have like
I have another answer for question 5.
okay, cool.
I think it's also important to be able to make decisions without like perfect information.
Yeah. Yeah, great, Evan. Yeah, as the book said, um, try not to like in the stock market, you can't like you don't have perfect information or like a lot of information. Excellent, Evan. Okay, 3 points. Okay, question number 6. You guys are like almost done with your questions. And it's a multiple choice question actually. That will give a lot of points. Anyways, the author wrote, at the end of 1972, when stocks, you know what? You guys can read it. Just read that whole blog. This whole thing. Now, this is Chinese paper. Chloe?
So I think so they just used what they saw from this information, like when the when there was a bull market, there were still plenty of bears. So I want to say they're like really dumb. I guess it's just human psychology, how they think. So
Yeah. Interesting, Chloe. This is like an open question too. Of course, there are some like maybe some answers that have a bigger impact, but most of this is a pretty much open question. Okay. As Chloe said, there is some psychology in this, but mostly it's just because like investors and the advisors aren't really like dumb, maybe sometimes a little bit unlucky, but it's just like by the time the signal to buy or to sell is reached, the stock market already changed. Like if it's going up and then finally it goes up so much that the investors and advisors are like, oh yeah, let's buy. The stock is gonna go up. By that time they've decided that the stock market already reached a peak and it's gonna go down because people are already starting to sell. And like the smart people are already starting to sell. Or like if it's going down, 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 and then finally people are like selling, they're like, this stock is terrible, and then it goes up. But by the time they like got that signal, it's like too late. So according to the chapter, what percentage does the price of an average stock fluctuate in an average year? Chloe?
in the book it said 50%. Well, he read something that said 50%.
Yeah. Great. Yeah. That's the exact answer. Um. So yeah. The price of an average stock fluctuates in an average year, and later there's gonna be like a kind of like a take-home activity, I guess. It's really quick. You don't need a lot of research or anything. About this. So question number 8. What trick did Peter Lynch give by the end of the chapter? Olivia?
So I think it was like wake up early, work hard, and then earn the oil. But I think by oil, it meant money or like what you deserve. I think that was it.
Yeah. Interesting, Olivia. Actually, he gave a lot of tricks, I think. Yeah, this question isn't really specific because if you look at the book, there's like 10 tricks he gave. But great. Chloe?
It said the trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them.
Yeah. Yeah. So great. Excellent, Chloe. Basically, he gave a lot of tricks. The trick I'm talking about is like, as Chloe said, not to learn to trust your gut feelings, but rather to like discipline yourself and ignore them. Because even if a stock is going down, you should stand by your stocks if the fundamentals of the company hasn't changed. Maybe it's just minor ups and downs, or like if there happens to be a bull market. Okay, chapter number 5. And I'll give you guys a second to read the cocktail theory in case you guys don't know, because it's actually pretty funny. So according to Peter Lynch's cocktail theory, what stage shows the stock market will go up soon? And the cocktail theory starts on page 87 of your book. So I'll give you guys a few moments to read it. Okay. Okay, so are you guys done with reading the cocktail theory? It's on page 87. So is anyone done with reading it? Wait, am I muted?
No.
Okay. Wait. If you read if you finished the cocktail theory, raise your hand. Okay. Do you guys know what it is? Okay. Then I'll give you guys a few more minutes. Okay. So you guys can lower your hands now. So according to Peter Lynch's cocktail theory, what stage shows the stock market will go up soon? Chloe?
It's stage 1 because this is in the this is when 10 people would rather talk to a dentist about plague than to the manager of an equity mutual fund about stocks, it's likely that the market is about to turn off.
Yeah, excellent, Chloe. Okay, so second question. According to Peter Lynch's cocktail theory, what stage is the riskiest stage? Kai?
The last stage, because it said that the market is due to a crash.
Yeah, amazing. So it said in stage 4, like when everybody, like even people who don't normally invest in stocks and who aren't like professionals or anything, give professionals advice, then it's like it's a sure sign like the market has reached its peakest peak and it's gonna go down again. And I actually have a really good real life example, okay? So listen up. So I think in 2021, I'm gonna clear this annotation. Okay. So in 2021, my dad, I think he told me this, he was part of this like stock chat and WeChat. And then at the peak of the stock market, or like not at the peak, but at like the top of the cliff of the stock market, at like one point, people were even like people in the chat who never even like invested in stocks before, like telling each other about what stocks to buy and like advising people. And those are people who were like amateurs who hadn't even like bought a single stock until then, and they were advising people on what stocks to buy. And sure enough, like a few weeks later, the stock market went like down like a lot. Like a few months later, the stock market went down a lot. So it's like Peter Lynch's cocktail theory. Once like even normal people are giving each other advices, and like when like someone gives you advice and it turns out to be pretty good advice and you wish you had taken the advice, then the stock market is gonna go down. Okay, so here's a multiple choice question. And thank you all for sharing. So this multiple choice question actually has 2 pretty bad answers, I guess, and 3 actually pretty good answers. But like one is the best, one is the second best, one is the third best, one is the fourth best, one is like the fifth best. So all in all, I'll just like read this question, okay? So when you're walking on the sidewalk in a neighborhood, a neighbor, not a professional investor, recommends a stock to you, saying the stock is an AI startup with great potential in the AI age. What will you do? A, buy the stock on Monday. Timing is important. If you do not buy it as soon as possible, the stock price will go up a lot. B, do research into the stock. If its fundamentals are strong, buy it with about 5% capital. C, ignore it, do nothing. D, sell all of your stocks. And E, start to worry about the stock market. And be prepared for a market crash. So, like you can get up to 5 points on this question. So the like best answer is 5 points, second best is 4 points, third best is 3 points. Okay, so Chloe.
Okay, so I would choose B because if it's like actually a good stock, but I also would do more than fundamentals, the research more than research about the fundamentals, because if the stock, the fundamentals, their business, their managers are really good, then you should buy it. You might earn a lot of money from the stock.
Yeah, great answer, Chloe. Livia.
Okay, what this is saying is that you're like say you're a dentist walking down the street and someone walks up to you and tells you how to be a dentist. Like that's what's going on in here. So I would say I would do B and like research it, but if I forgot about it because why I don't know, I would probably end up doing C, but I'm gonna say B.
Okay, great. Kai?
I also think it's B. I would do research because it could go up, but if the fundamentals are bad, I wouldn't buy it.
Yeah. Okay, great. Oh yeah, Oliver, I'm gonna give you a point. Wait, so Oliver, is your choice number 1 or number 2?
My first choice would be B.
Okay. Okay, Evan?
Yeah, I would also say B.
Okay. Okay, so B is actually would be my second choice actually. Do research into stock. If its fundamentals are strong, buy it with about 5% capital. That is really good advice, okay? But there's a but, okay? So B is like a really good like advice, but if like your neighbor who's normally not like investing in stocks and isn't a professional investor recommends a stock to you, you should do research on the stock. That yes, but you should also start to worry about the stock market and be prepared for a market crash, like in Peter Lynch's cocktail theory. But all I think yeah, B is pretty correct. I think there's like 2 like correct answers in this, and I can see your point of view. Personally, I was split, but yeah. Personally, in order of ranking, I would, and this is like my own personal, okay? Because this is about the cocktail theory. I would do no. This is number 1. This is number 2, and this is number 3, number C. Because if it's not a professional or someone like who's a legendary investor, sometimes you shouldn't really take the advice. No. Okay. Oh yeah. And here's like kind of like a homework, I guess. So Peter Lynch said that individual investors can find great stocks by looking around his or her home, work-life environment, and so on. And he also mentioned that an average stock fluctuates about 50% in an average year. So this is actually not really like homework because this is really quick. It'll only take you at most like 10-15 minutes if you're quick. Like maybe like 10-15 minutes. And while it does include a little bit of math, not much. You can use a calculator if you want. So step number 1, try to look for 10 good companies around you and find the stock tickers. For example, Disney, Apple, Tesla. Then choose one company from the 10. Give like the reasons why you chose this company. So like you have a list of 10 companies, you might choose number 6. Well, no, here's an example actually. So give the reasons why you chose this company and then calculate the fluctuation. Okay, calculate the fluctuation percentage of the stock in 2023, 2022, and 2021. So the fluctuation percentage is about it's like the lowest point and the highest point, like the percentage, like the percentage of fluctuation. So here's an example. There are 10 companies around myself: Disney, DIS, Apple, AAPL, etc. So I chose Disney. I think the company is a good company because blah blah blah. So this is kind of like your format for this, like what your format should be for this. And then In 2023, the stock's highest price was 118.18 so far, and its lowest price is 79.75. Its fluctuation percentage is 48.2%. In 2022, the stock's highest price was blah blah blah. Its lowest point was blah blah blah. Its fluctuation percentage was about 91%. How you calculate the fluctuation percentage is you take the highest price, which might be 100, and the lowest price, which might be 25. Okay, so you first take 100 and you minus 25, and then you divide it by its lowest price, which is 25. So that's like, and that's like, wait, hold on. I did it wrong. Okay. Ooh, this actually divides evenly. Okay. That's like, I don't know what I thought. Undo. So that's like 3, right? So that's like, wait. I think it is. Okay, so evidently this stock fluctuates a lot. But like this is a bad example, okay? I think no stock fluctuates this much. Okay, I chose a bad example, okay? But like here you see the percentage, the fluctuation percentage is 300%, right? Okay, so it's like 0.300%. And then you basically divide the highest like price by you subtract the lowest price from the highest price and divide it by the lowest price. You get a decimal and you get a percentage. So you can do this so like you can do this on a slide, on a Google document. You can just type it out or anything. But the due date is 1 day before the next meeting. So you have like nearly 2 weeks. Okay, does anyone understand or have any questions?
Like, do we send it to you or something? Like our homework? Or do we put it in Google Classroom?
You put it in WeChat, or you can put it in Google Classroom too. You not just put it in Google Classroom. So put in Google Classroom. Put in Google. Okay. So you guys can take a picture of this. I don't care, but it's a recording. So yeah. Does anyone have any questions about this? None? Okay. Well, thank you for attending this meeting and see you next time.
Bye.
Bye.
Okay, bye.